Hello and welcome to today's market commentary. However, we're doing this on a topic today. I'm joined by uh, two of my fellow colleagues. We have Evan Radin here, as well as Amanda Aliska. So we're going to be talking about estate planning through revocable living trust, which we've already launched a video on our YouTube channel about, but this is going to be kind of um, um, an extra kind of estate planning session that we have over on top of that. We're going to be adding some material to that. And we're rounding out to estate planning month, right? Which is October. So it's a timely video. So really, we're going to be talking about some of the different concepts that people think about when they use trust, why to use trust, why not to use a trust, what are some of the um, things to think about when you're implementing a living trust. So, without further ado, here, let's get into it and let's talk about some of the estate planning statistics, Amanda.
Yeah, of course. Why this topic is so important. More than half of Americans have no estate plan at all. That means many people are leaving major gaps in things like beneficiaries, titling of assets, or even clear instructions for their families after they pass. And when that happens, assets can be stuck, essentially in limbo. In addition, about 31% of Americans don't even have a will, and a will is, the basic fail-safe that carries out your wishes when you pass. So without one, the courts decide who gets what. And that very might well be very different from what you intended. And even if you do have a will and it is being used after your passing, that means your estate is going through probate. And for anyone who doesn't have experience with probate, it's expensive, time consuming, and public. On average, it can eat up 3 to 10% of your estate and fees. And that's money that's, going to courts and attorneys instead of your loved ones. And that's why that brings us to today's focus of trusts. Only about 11% of Americans have one, but they can make a big difference. And we'll walk through, what you might consider a trust and the key benefits it provides there. So just now to put things a little bit in perspective with some history, back in 2001, if your estate was worth more than 675,000, it could be taxed at rates as high as 55% after your passing. That meant many middle or upper middle class families, especially, employees with retirement accounts, were impacted by estate taxes, which made creating trusts a very valuable way to shift their assets from their net worth to avoid paying those taxes at passing. A little bit fast forward to today, thanks to, a series of tax law changes over the past 2 decades, the exemption is now nearly 14 million per person in 2025, and in 2026 they're 15 million, and it's adjusted for inflation every year. So essentially, 22 times increased compared to '01 there. So today, very few estates actually face federal estate tax, but just because estate taxes aren't as much of a concern doesn't mean, trusts aren't as valuable today. They still provide key advantages that still apply. First one of those being avoiding probate. As I mentioned, a lot of people think having a will keeps them out of probate, but that's not, true there. In fact, if you have a will and your estate is going through probate, probate isn't quick or cheap. It takes close to 2 years on average. And like I mentioned, up to 10% in a state, of your estate and fees there. Second is privacy. Wills are public record. So when they do go through probate, anyone can see or look up, what you had and who you left it to. And trusts, on the other hand, remain private. The successor trustee named in your trust just steps in, carries out the instructions, quietly and efficiently there. Third benefit is incapacity planning. A trust can spell out what happens, if you're unable to manage your affairs. For example, There can be language in there requiring a doctor's note before a successor trustee takes over. So it avoids kind of the messy court process of appointing a guardian. And lastly, creditor protection. With the right kind of trust provisions in there, your beneficiary's inheritance can be protected from creditors or even something like a divorcing spouse there. So in short, the key benefits are avoiding probate, protecting privacy, planning for incapacity, and really safeguarding your legacy. And
Awesome.
I
Thanks,
will,
Amanda.
yeah. hmm
Evan, what do you got in terms of understanding basis? When people talk about this, what do they mean? Why does it relate to this topic?
Yeah, so shifting gears a bit, but still within the trust realm, it's really important to understand what the step up in basis is. So let's take a look at an example here where a parent buys a home for $100,000 and over time it's now appreciated to 700,000. First, let's take a look at the worst case scenario. Worst case scenario is before the parent passes away, they gift the whole house to their child. Their child then goes and sells it the next day. They have to realize 600,000 in gains and pay taxes on that. Now, let's look at a not as bad scenario, but still not the most efficient, is right before the parent passes. Let's assume that it's a couple owns the house. They do have a 500,000 exclusion of gains on the primary home. So in that example, the parents only pay 100,000, realize 100,000 in gains, need to pay taxes on that, and then gift it to the child. But the most efficient way to do this is to utilize the step up in basis. So in this example, again, parents buy the home for 100,000, appreciates to 700,000. It's still in their name when they pass. Then the child gets a step up in basis to that 700,000, the fair market value when the last parent passed. And if the child goes and sells it the next day, they realize no gains. If they sold it for 700,000, they receive 700,000 and do not need to pay any taxes on that. And that's a similar situation as a non-qualified, non-retirement investment account. So not an IRA, a non-retirement account, similar scenario, you get that step up in basis as well.
And Evan, does this happen automatically? Do people have to do something to qualify for a step up in basis, or is that just what happens when you die?
That's just what happens when you go to file the taxes the next year.
Got it. Okay. So very important part. Um, what else do you got?
So it's important to remember what is qualified for the step up in basis and what doesn't. We talked about the type of assets, the property and the non-retirement investment accounts. And if it's held individually, you get the step up. But also, if those assets are held in a revocable living trust, you still get that step up. A very important key there. There are some trusts where you do not get the step up in basis, where if it's an irrevocable trust, you no longer get that step up because it's no longer in your estate. And you're doing that for a different reason, whether the parent is trying to get some sort of tax benefit today, you're trying to appreciate the assets outside of your estate. So there are different reasons why you would want to get it out of your estate and not get the step up in basis. But it's important to note here that you do get the step up in basis if it's a revocable living trust.
And before you go on to the next slide, Evan, I think it's important to kind of point out that there's two distinct paths that you can take with a trust, right? One is you are utilizing a trust to avoid estate taxes at the end of your death, right? At death. And back in 2001, that was an issue that happened a lot because the estate tax threshold was at 675,000. Now it's 13.99 million and that number's going up. So no one really that we deal with needs that to happen. We don't need to avoid those estate taxes, right? Because when you avoid those estate taxes and you use a trust to avoid those estate taxes, so we could say that these four trusts avoid estate tax, have the estate tax exemption. What happens there is it eliminates that provision where you get the step up in basis, right? It eliminates that provision. And the majority of our clientele want to preserve the step up in basis and don't need to worry about the estate taxes being a problem for them because of how high that exemption is.
30 million for a couple.
Exactly. So we want to focus on the types of trusts that keep that step up in basis intact. So given the fact that the revocable living trust meets that requirement, what are some of the special things that come with a revocable living trust, Evan?
Yeah, so if we go to the next slide here, number one is the revocable living trust is immediate. So once you get the trust, you implement it today versus the will is more of a triggering event. It waits until death to go into place. And just like the title suggests, revocable, you still keep control of the assets. So whether you want to change your investment selection, you want to change the beneficiaries, you do have the option to you still retain that control within the trust and of those assets. And it's adaptable. So if you draft up the trust today and the situation, life changes down the road, you can change those beneficiaries, and it's not too complicated to adjust your trust.
Perfect. And do all the four things that Amanda you covered, like avoiding probate, those four items apply to this revocable living trust?
Correct. Yes, they do.
Okay. So those are the features that we kind of get standard when we get a revocable living trust. And I think the immediacy to me stands out here because the probate process can take some time. And when a trust owns assets, it's immediate. The successor trustee takes over and essentially now is the trustee of this trust, where you don't have to wait for courts to do their thing and create, letters of testamentary and executor and all that stuff, that can delay that process, because there's kind of some other things that go into, when you inherit an estate through a will, right? You've got to get a tax ID on the estate. So you have to go to the IRS, draft a tax ID for the estate, create bank accounts for the estate. And when you're cashing out investment accounts or bank accounts, you have to cash out these accounts to an estate bank account. Whereas if you had a trust, you could literally cash out these investment accounts directly to the beneficiaries. You don't have to do these extra steps at the end. So it's kind of interesting when you think about it, right? You have to do some extra steps at the beginning by creating the trust, few more than the will. You have to title properties to the trust and things like that you're going to talk about, Evan. But in the end, you're saving that time and expense for the beneficiary. So going a little further with this, and I know we got questions. Jeff, you've got the first question up. We're going to make sure that this is answered. Just so that we can get everybody out in appropriate time, we're going to go through the deck and then end and do Q&A. I'm going to just talk about some extra bells and whistles that can be added to a revocable living trust, which is essentially the trust that the majority of our clientele should be using, right, based on the step up in basis. So, and An extra bell and whistle that can be added to a revocable living trust is what's called disclaimer trust. And it offers what's called post-death planning flexibility. And essentially what it does is it offers your spouse the ability to take the assets out of the estate after you pass if your estate is going to cross over those estate tax levels. I'll explain that in a chart coming up here in a second. Additionally, an extra bell and whistle that you can add in is what's called a children's subtrust. A children's subtrust allows you to position your assets so that they go, instead directly to your children, they can go into a trust that is created after you pass away, if that's what you state in your trust. And essentially in that trust, you can create some guardrails. You can also give your children the ability in their own subtrust to avoid estate taxes for their heirs. But one of the clauses that can be added to this subtrust for your children is spendthrift clauses. So it prevents creditors access from those trusts, but it also prevents reckless spending. So let me kind of give you a visual of this, right? So a revocable living trust is created typically for each spouse, right? So let's call this revocable living trust my trust. And let's call number 2 the revocable living trust for my spouse. So when I pass away, generally 99% of the time, my assets are going to flow into my spouse's trust. This is where the step up in basis will stay intact. But anything that goes to my spouse's trust would be subject to estate taxes if the estate was over the 13.99 million threshold. So let's say the estate was going to be $15 million and it was going to be over the 13.99, call it 14 million. What my spouse with their attorney could do at this point is send 14 million to the spouse's trust to keep the step up in basis intact on that 14 million, but send the 1 million that's the overage to what's called the disclaimer trust that avoids that estate taxes because it's actually held outside of the taxable estate when you send it to a disclaimer trust. And that is an option that can be written into your trust that gives your spouse the powers and ability to do that if for some wild reason your estate grew to over the estate tax threshold, which is currently set at $14 million. Okay. Now, again, I said 99% of the time, it's all going to go into the spouse's revocable trust because you're not going to be over that number. But if you were, you got that option to avoid the estate tax on that piece. And that's how you do it. You write in provisions for a disclaimer trust. Okay. Now, the disadvantage to a disclaimer trust is there's no step up in basis there. And again, the advantage is that you retain the estate tax exemption on that 1 million. Now, from here, this is where after the second spouse dies, number 4 on this chart is what happens after both trusts are essentially done, right? The revocable living trust of me is finished because it's been absorbed by my spouses and those assets go into my spouse. And at the end, the beneficiaries are there. The beneficiaries outside of my spouse are there. So do we send those assets directly out to, let's say, my children? Or Does that give me a little bit of anxiety about how they're going to spend those assets? Would I prefer that they still be kept in trust, but a trust now created in their name with maybe some provisions on how they can spend that money? All right. And what's unique about trusts is that in my revocable living trust up here in number one, I can write in a spendthrift clause on one child and I can omit that from the other child. I don't have to have the same parameters for each children. If one, I just don't trust on how they're going to use that money, I can very much write a different parameter on the asset protection trust for one child versus another. Okay. In addition to that, it gives my children the option to also disclaim assets from their estate if they're going to be at higher earning levels as well. So it gives them flexibility for children that may have high earning capacities that would want to keep this in trust. Okay. But for children that do not meet any of those requirements, I can also give that provision in the child for, hey, just at the end, this is going to go to your asset protection trust. But if you don't want to keep it here, you can cash it out right away, right? You lose some creditor protection, you lose the probate, all those types of things, but it might make it easier on you if you want to just manage this outside of the trust. So you can give that provision too. So those are some advanced things that you can do with your trust. Let's talk a little bit about the aspects that involve retirement accounts. And Amanda, do you mind giving us a little bit of an understanding on that?
Yeah, of course. And, Evan touched on, what happens with property as well as those non-retirement accounts. But for retirement accounts like, your TSP, 401k, IRA, there's some unique considerations. These accounts have special tax rules, especially when they pass to a beneficiary. And if the trust language isn't necessarily detailed properly, you could unintentionally trigger immediate taxation, accelerating the income tax that your beneficiaries will owe on your legacy. But with the right trust provisions, your beneficiaries could be able to keep stretching distributions over their lifetime. And that preserves the tax deferred growth inside the account. It could save them, hundreds of thousands of dollars in taxes over the years. It's also essential to make sure, that TSP or that retirement plan has the right beneficiaries forms lined up with the overall trust strategy. A mismatch between the two could really undo all the planning that you've done. So really extra diligence is needed to coordinate, double check the language and just make sure your trust and the retirement accounts are working hand in hand there. So it's a little bit different than, just property or the non-retirement accounts that you have.
And typically, Amanda, I think, in having 300 client household plus households, right, and working with their estate planners, what we see when it comes to beneficiaries on retirement accounts is if someone has a trust, we will typically see that the spouse is the primary still. The
Correct.
actual
Yes.
person is the primary beneficiary and not the trust. But the contingent beneficiaries, meaning after the spouse is gone, that is typically listed as the trust. That's how we have seen this chalked up when we're receiving instructions from the estate planners that draft our client's trust.
Yeah, and one more thing to note there, when it comes to the non-retirement accounts and the property, the trust owns those assets. They are the title owner. When it comes to IRAs, 401ks, TSP, you can't have the trust own those assets. Those have to be owned by an individual.
Right,
We're
which is
talking
why
about.
which is why the beneficiary of the IRAs need to be set up properly. And the language needs to be in there if you're going to use the trust as either the primary or contingent beneficiary,
Right.
which again, we typically recommend using the trust as the contingent and still using your spouse as the primary, unless there's, an overwhelming reason for why you're not going to do that. If you're on a second marriage and you want to make sure that the trust governs this right off the top, that would be a reason why you'd want the trust as your primary um, beneficiary and not just the contingent. But okay, Evan, what do you say in terms of after we're done this process, we've created everything with our state planner, the documents. What are we doing?
How do we actually implement the strategy? So step one is you need to draft the trust documents, whether that's doing it on your own, which is not recommended. Working with an attorney to draft those documents is the recommended route to do that. And the cost of that is a couple of $1,000s. And working with the estate planning attorney to get the goals that you want accomplished and drafting the document in that manner. That's the first step. But that is not the last step. Once you have the trust in hand, you need to make sure that you're titling the assets in that trust. So whether it's the non-retirement account, you want the trust to now own, be the owner of those funds. You need to retitle that account so the trust is the owner. Same thing for the property. Once you have the trust, you need to make sure that you go and record the new deed with the clerk and make sure that it is actually the new owner of those assets. And going back to the last slide, if you're going to implement the trust as the beneficiary, making sure that you're updating those accounts and adding the trust as the beneficiary. And make sure that we're reviewing this going forward. As we know, life happens, things change, tax laws change, life situations change, whether that's a new marriage, financial goals change if you want to help one child more than the other. So making sure that we're reviewing these documents, not necessarily on an annual basis, but not going a decade either, making sure that we have a regular review to make sure that the estate plan that we have in place still makes sense.
Perfect. All right. So the team is comprised really of the 9 professionals you see on the screen. We really run this as a team show. We've got 4 advisors here, including myself and Amanda, and one that's not here today, which is Austin. But anybody that is not a current client that'd like to register for a one-on-one, it's a complimentary session via Zoom. You can do so right there on the left side here. Most of people tuning in today are clients. So if you're a client and you do not follow us on YouTube yet, please follow our YouTube channel, right? You can take your phone out and scan this QR code. It will launch our YouTube channel. Hit subscribe because we are posting videos on a weekly basis. This is just a 1 month thing, like a jam session of a couple different ideas that we had. But if you want to follow topic specific things, please join us on YouTube. And if you're on your browser, type in Capital Financial Planners 2015 YouTube, and we will pop up. Please subscribe to our channel and get those timely updates because we've always got some fresh new stuff hitting that channel. And that's really been our initiative.